While the U.S. life annuity industry performance in 2017 can be characterized by strong balance sheets and good earnings, AM Best's market segment outlook for this area remains negative. Here to discuss the issues and challenges facing carriers in this segment are Director Tom Rosendale and Senior Director Ken Johnson. And Tom, let's start with you. The challenges for the life annuity industry have been well documented in recent years. How did the industry fare in 2017, and what's the outlook as we move forward?
Well, John, the outlook is about the same, quite frankly. In 2017, individual life sales were up about 2% through 3 quarters, and that's about what we would expect for the year. That follows a year of about 3% growth in 2016. For 2018, again, low single-digit growth, pretty much more of the same. On the individual annuity side, it's a little bit different story. We saw 2 consecutive years of declining sales. 2016 was down 6%, primarily driven by variable annuities. In 2017, we saw basically across the board declines of about 10%. So that's across all product lines in the individual annuity space. So given that and the fact that the DOL implementation that remains has been pushed back to 2019, things look pretty much the same in 18. So we're going to see flattish sales, I think, on the individual annuity front. But bear in mind that's on a much declined base over what it looked like a couple years ago.
Now, an AM Best survey shows that product distribution is a crucial area of concern for the industry. What does that mean, and what could it mean for the traditional agency networks?
Well, I think what it means is that the industry is not really well situated to market and to deliver product, primarily to the middle market. And so we're going to expect that the industry knows that it needs to ramp up its application of technology and the use of data in order to develop new channels or to revise existing channels, to access that broad middle market where we have not been very effective over the years. What that means for the individual agents, both career and independent, I think is that they're really not well positioned to access that market, right? The cost of that distribution channel is high, turnover is high. Pressures are going to continue on the fiduciary front. So, we think that the independent career agents are better suited for the affluent, mass affluent, and high net worth markets than they are for the middle income markets. So, really what it means is they've got to develop new channels before someone comes in and does it for them.
Ken, what is the recently signed tax reform legislation going to mean for the life and annuity industry, both positive and negative?
Well, certainly overall, it's going to be a net positive. Just moving the rate down from 35% to 21% is going to flow right to companies' bottom lines. And those companies that actually compete with some international players will also find themselves to be a little more competitive as well. On the negative side, for some companies that had a net emitted deferred tax asset position, there had to be a write-down there, and therefore their surplus will go down for a period of time until they earn some of that back through the higher net income that they'll be earning. Another small piece was known as the base erosion and anti-abuse tax. This impacted companies that had, say, foreign subsidiaries off in Bermuda, where they were getting a little bit of a tax advantage. Now those companies are losing some of those advantages, so there may be some organizational changes, or they may simply elect to be U.S. taxpayers in order to get around what is affectionately known as the BEAT tax.
Now the report notes that carriers' technology ability needs to improve. Why do you suppose carriers have been slow to respond?
Well, it might be a little unfair to single out the insurance industry for being slow. I think most industries have been caught by the exponential growth in technology. Initially, companies were more focused on their back office legacy systems, or maybe they acquired a couple systems through acquisitions and needed to consolidate. And then more recently, dovetailing what Tom talked about on the top line growth, companies had pushed more into the front end and tried to come up with apps to speed the sales process, maybe improve the close rates of those applications. But maybe in the last year or so, technology has really taken off, and now companies are realizing that they're exposed throughout their value chain, and they really need to make some expensive adjustments to really digitize their companies much more efficiently.
Tom, what are some of the recent transactions, such as MetLife's spinoff of Bright House and Voya exiting its annuity business? Tell us about where the industry is headed.
Well, I think it means that companies are still interested in exiting some of their non-core lines, both for risk management purposes and strategic purposes. So that's on the sell side. On the buy side, we're seeing some interest, I think, continuing interest in some of these blocks. We've seen a lot in the past of private equity having interest in annuity blocks and strategically repositioning the investment portfolios for better returns. We still see that. One of the themes that we're seeing with some of these acquisitions is partnerships amongst private equity. So multiple private equity firms banding together to make acquisitions. Again, primarily in the annuity space. We've seen, as you mentioned, Voya. Hartford also has announced a disposition of its variable annuity business. So clearly the VA businesses have, those runoff blocks have improved sufficiently from the financial crisis such that they're attractive to at least some buyers. What we haven't seen is too much interest yet in the long-term care blocks. So that's kind of what's stayed behind with some companies. Some of those runoff long-term care blocks, I think the industry feels, and those outside the industry probably feel, that they're under-reserved to some degree. So it may take a while before buyers and sellers come together, even though we've seen some interest expressed on the buy side for long-term care, not at the prices they're willing to be sold at the moment. Longer term, I think, again, to Ken's point around technology, many points around technology, I think that spend, which we see across a number of our companies, a much higher spend in technology, and we think that'll probably accelerate over the near term. At some point, not in the near future, but at some point it's going to pressure companies to do further consolidation. So I think it's going to result in some of the smaller players that can't really afford that big spend to seek partners.
Ken, we've been seeing some upward movement of interest rates in recent months. However, insurers have been saddled with declining portfolio yields for years now. Is there any concern about the level of risk insurers are taking on in their portfolios?
Yeah, I guess there is a concern, John. Sustained low rates and really very low credit spreads have really led to maybe the relative value of these assets not properly pricing in the risk that's inherent in some of the more illiquid securities. Those we look at it right now as a total risky assets, the capital and surplus still hovers around 100%, which is fairly high. Now this is for the industry in total. But I think as we look at the portfolios, there more time is spent around ALM and liability-driven investing than we might have seen, say, pre-crisis. So I don't think we see the downside to be as severe as it might have been at the crisis point. Some of the areas we are watching, though, is there's been a renewed interest or an increased interest in private credit. And this is where insurance companies are making direct loans to corporates or in the real estate market, an area that was pretty much covered by the banks but stopped with regulation of the Dodd-Frank Act. So when they start to reach out into areas outside of their expertise, we pay a little more attention.
Ken, Tom, thanks for joining us today.
Thanks.
Yeah.
You can find the full report online at ambest.com. For AM Best TV, I'm John Weber.